During a crisis period, when capital growth in equity markets kind of stalls, people turn to income funds because they provide a steady stream of cash payments. And 2022 is no exception. We've seen high dividend yield funds outperform every other factor. So the question is, will that continue? And should high income funds be part of your core allocation? So those are the questions we'll answer in this video. Let's look at income funds in a bit more detail. So what do we mean by factors? Well, if you're familiar with Warren Buffett, he's a value investor, which means he buys cheap stocks. There are various measures you can look at to see whether stocks are cheap. For example, that might include price to earnings multiples, or maybe price to book value. That's another measure. But essentially, you're looking for stocks which are cheap, and those tend to outperform markets over the long term. Another factor to consider is growth stocks, which are kind of the opposite of value stocks. These are companies which are aggressively growing their profits, but also aggressively growing their capital and their share price. So for example, tech stocks over the last decade would definitely be classified as growth stocks. Another factor that's outperformed long-term is size. In other words, you buy small companies rather than large companies, and those tend to outperform the broad market. Perhaps these are because these companies grow faster because they haven't saturated their markets yet. And that's assuming they're successful, of course. Another factor that performs well is momentum, where you simply buy stocks which are rising. That tends to go on for longer than it should. And by buying into this kind of herd mentality, you can actually outperform over the long term. The only times when it goes wrong is when one of these trends reverses. And the factor we'll focus on in this video is high income. So these are stocks which pay out a high dividend and which don't focus on growth. Now here's the performance side by side of all those different combinations of factors. So here we've got value, we've got growth, we've got small caps, we've got large caps, and the factor which is done by far the best is here, which is VYM, which is the high dividend yield ETF, which is created by Vanguard. That's managed to outperform not by having an incredible return since November last year, but by simply not falling. Whereas if you look at the other factors, you can see that anything which is small cap or momentum or growth oriented has underperformed in 2022. So if we're comparing stocks or comparing funds, how do we filter out the ones which are paying the highest income? The way we usually compare is to look at something called the dividend yield. So the numerator here, which is in blue, is the income which you're paid. This will come as a cash payment into your brokerage account, and then you can do whatever you like with it. Now you want as much of that as possible. Now ideally, you'd pay as little as possible to get your hands on that income. So what you want to minimize is the price that you pay today. So why is it that some stocks offer a much higher dividend yield than others? Well, really that's the choice of the company, and this is ultimately down to the management of the company. So let's imagine for a moment that we've got a company which is very profitable, and we have a bunch of choices as to what we can do with that cash. One choice is to pay out a very high dividend to our shareholders. This will obviously please them, but it does have drawbacks. Another choice, which is often made by US companies, is to take that cash and buy back their own shares. That way, the price of the stock usually goes up, because remember, the remaining shareholders will have their ownership of the company concentrated. So it's as if you've bought more of the company without having to pay for it yourself. That rewards capital gain, an increase in price, and the effect of that is to increase the share price. And then the final choice is to take our cash and reinvest it in our company. That way we can organically increase our profits and also increase our share price over the long term. Now, of course, there's a trade-off here. So if we've got a high dividend paying stock where we pay out a lot of our profits to shareholders, then we can't reinvest it back into the company to grow the size of our company. So it's very unlikely that you'll have a company which is both a high dividend payer, so its payout ratio is high, it pays out a large proportion of its profits to its shareholders as a proportion of its profits, and at the same time the company grows its profits and increases its share price a lot. So why is high dividend as a factor outperforming in 2022? Well, you can see a clue in this bar graph, which is showing the performance of all of those factors since the beginning of this year, actually since November, which is when markets peaked. And yes, you can see that high dividend yield has been the best performer, but notice that the other good performances come from value funds. Large cap value with IVE, pure value with IWD, but also mid cap value with IJJ. And the worst performance since the beginning of the year has been growth funds. These are the ones which did incredibly well until recently. So is the Vanguard High Dividend Yield Fund, VYM, just another flavor of value? Well, this nice grid that you can see from Morningstar shows that yes, that's exactly what it is. So in the columns here, we've got value to growth as a style. And in the rows, we've got large cap to small cap. And you can see the tilt of this fund is very much towards large cap value. That's because dividend yield is just another measure of value. It tends to select stocks which have a high income relative to their price. So that is a measure of cheapness. And if we look at the correlations between stocks, this is what I call a Scooby-Doo tree, but essentially the tree just shows you which funds tend to move up and down together. If they do move up and down very closely together, then they have a high correlation and they sit close together in the tree. So that's the case for these three funds. Two of them are value funds, IWD and IVE. And look, you can see that VYM is part of that tight little cluster. And on a separate branch of the tree, you can see that it's quite distantly placed. You can see these two growth funds, which are highly correlated with each other. The reason why correlation matters is that you don't want to double up your risk. Ideally, you build your portfolio so that it's as diversified as possible. That way it can survive pretty much anything that markets throw at it and not suffer huge drawdowns. And if we look at the performance of those two clusters, the growth cluster and the value cluster, yes, they have moved very much in lockstep with each other since 2006. But this is another reason why I think value is now outperforming. What we saw recently after the pandemic particularly was a huge rally in growth stocks. And that pushed up their valuations hugely. And all we're really seeing now is that as interest rates increase, those valuations are coming back down to earth. And as a consequence, value has simply held on to its price, whereas growth prices have simply plummeted as their valuations normalize. If we look at the actual returns since 2009 for growth funds until we saw the sell-off at the beginning of this year, you can see that growth has just done incredibly well, with an annualized return of just under 20%. Dividend yield, on the other hand, and value funds have had a respectable return, just under 13%. They've simply underperformed the growth style of investing. So if we compare those two funds, VYM and IWF, so that's high dividend yield in the top panel versus Russell 1000 growth in the bottom panel, you can see that they kind of move in opposite directions. When one is rallying, the other one is usually falling. And the beginning of this year is no exception. So I think part of the reason for the outperformance this year has simply been a normalization of valuations. The Fed's raised interest rates, egregiously outpriced companies have had their prices fall, and that simply favored value over growth. But that immediately should raise some alarm bells. You should be thinking, well, is this outperformance of value and income going to persist? Before we move on to the really important question of whether high dividend yield funds will continue to outperform, let me just quickly mention our free weekly market roundup. This is published every Friday. I try to make it interesting. It mentions macro, but also markets and how the two interact. And it's a good way to learn about investing and keep abreast of what's going on. If you want to learn more about that, just click on the link beside me and in the description beneath me. So now let's have a word of caution about income investing. What I've shown here is the quarterly outperformance of VYM versus the broad US market with SPY. Now notice the quarter when it really outperformed was in 2008. So this was Q3 of 2008 when really the global financial crisis was at its worst point. And in that quarter, you can see that VYM outperformed the S&P by 16%. And of course, this occurred as the S&P was plummeting. I suspect this was because people were cautious and they fell back on that safety net of income. And that's presumably because they expected capital growth would suffer for some period of time to come. However, that faith in VYM and income was fairly short-lived. It only lasted one quarter, and then it had 2 quarters of underperformance. by 6% and by 7%. Then it went through that long period of underperformance, which we've already seen. Now, recently, we've had 2 quarters of outperformance by 5% and by 8% during the first 2 quarters of 2022. Now, personally, I think that that'll continue as long as valuations stay elevated in growth stocks. That normalization is far from finished if you actually look at the numbers. And while that's the case, and we see growth valuations continue to compress, I think that funds like VYM will continue to perform well. Once it's finished, however, I'm not so sanguine on the outperformance of VYM. Now, when equity prices fall, what we'd expect to see is that dividend yields would rise. That's simply because of the way that dividend yields are calculated. Usually we take the previous 12 months dividends which were paid, and of course that varies very slowly, and we'd be dividing by the price today, which has fallen very rapidly. And of course that makes dividend yields shoot up. But what would be really worrying for income stocks is if we get a recession, because usually that means that income would fall for companies and their natural response would be to cut their dividends. That's perfectly within their rights, because companies may be worried about survival and keeping profits. So they don't want to carry on paying a lot of those profits out to shareholders. They want to preserve their cash. And in turn, what that might mean is that the dividends paid would fall and dividend yields would also fall, even for sound companies. And then all of the stocks which were paying out high dividends up to that point would just be left with fairly low dividends, not particularly high dividend yields either, and not great growth prospects. So suddenly income funds would be very unattractive indeed. So I think it's really important to keep your eye on whether we're going to get a recession, because it's obviously going to affect this style of investing. I also think there's a fundamental problem with high income funds. And I think it's captured very well in this article in the FT, which was actually a comment by one of the fund managers at Marshall Wace, which is an active fund manager. And you can see the title is that London's becoming the Jurassic Park of stock exchanges. Now, the reason for that is because of the focus of UK fund managers on income. Now, that arises because these fund managers believe they have a mission to protect the incomes of pensioners, which is an honourable objective. But as a commentator says, that leads to insist on companies paying out the lion's share of their income in the form of dividend rather than investing it back into the business. As we saw earlier, that's going to starve the company of resources which it can then reinvest into its own business to grow its earnings organically. And the article goes on to say that this is a form of financial decadence, discouraging capital investment and stifling growth and productivity. But he certainly has a point. This is why the UK equity market is only now 4% of global equity markets, whereas the US is about 60% of global markets. The US has simply been much better at capital growth, and that's ultimately what drives market capitalization. Now, when I speak to UK investors, there's usually a huge focus in their portfolio on dividends, as we saw with UK fund managers. But as it's the case that the US makes up 60% of global equity, that's not going to be very successful. And that's because the US is massively tilted towards generating capital gain. This is why companies like Apple have been buying back huge amounts of their shares, because the deal with those companies is that they give you capital gain, not high dividend. And it's likely to be the case that the US will dominate for some time to come. I think it's much better to focus on total return, which is a combination of dividend and capital gain. In other words, you buy at a low price and sell at a high price. But if you do want to get access to high dividend income funds, a good place to start is to look at global income indices, because these are the indices which passive funds will track. And one of the most popular ones is this one from MSCI. It's their MSCI World High Dividend Yield Index. Now, MSCI World is just developed markets. That's the first thing to notice. But the other point is that it doesn't just look for high dividend yields. If it did, it would tend to favor stocks where the price has crashed, usually for bad reasons. So usually high dividend yield funds will also screen based on some kind of quality approach. Either the dividends will be increasing rapidly, or they'll be sustainable because earnings growth is also steadily rising. So in this case, the index is actually looking for companies with high dividend income, of course, but also quality characteristics where the dividend yields are both sustainable and persistent. So this isn't the kind of dividend that will just disappear rapidly. They also screen for stocks where there's potential deterioration of their fundamentals. Perhaps there'll be a collapse in profits, but they're looking for any kind of factor which would cause them to cut their dividends. But even in this brochure, which is effectively selling the index, you can see that the yellow line, which is MSCI World, has significantly outperformed the blue line, which is the MSCI World High Dividend Yield Index. So this is the index we just looked at, and this comparison can be found on JustETF, which is a brilliant website. It's free, and you can look up any of these funds. But the row which I think is most interesting in this comparison is the one labeled selection criteria. These are the additional criteria which the index provider looks at to ensure that they're not just buying recently crashed stocks, that there is some kind of quality filter behind the stocks that they choose. So in the case of the FTSE All World High Dividend Yield Index, they try to look forwards at what dividend will be paid in future. So that requires some form of analysis. And in the case of this S&P Global Dividend Aristocrats Index, what they're looking for is rising or stable dividends for at least 10 consecutive years. So that's a very stringent filter. The SG Global Quality Income Fund looks for different quality factors, presumably multiple ones, but also how healthy the company's balance sheet is, in addition to its dividend yield. And the Stoxx Global Select Dividend 100 Index looks for dividend quality. Presumably they're looking to see how easily the profits of the company can cover the dividend, something called dividend cover, but also having a non-negative payout ratio. The payout ratio is the percentage of profits which are paid out as dividends to investors. Now let's look at some particular ETFs for UK investors. It's certainly not an exhaustive list, but if you want to find these for yourself, just go to JustETF and look for dividend yield or high income. So what I've done is to sort these funds by fee. So total expense ratio is the criterion by which I've sorted, with the cheapest at the top and the most expensive at the bottom. You can see you've got various choices such as the fund currency, the size of the fund, but also whether you receive the dividends in the form of cash or whether it's reinvested back into the fund. I personally always go for accumulation funds because I don't want to receive those cash payments and have to reinvest them myself. But you'll notice that the yields which are in the final column are not particularly high. They're all about 3% or less. Also notice that the fees are pretty high. My threshold for expensiveness is usually about 0.2%. You also have choices about whether you want ESG funds. So this first fund you can see at the top is a high dividend climate ESG fund. So that has an additional climate ESG filter applied. Then we get to these two Vanguard funds. Essentially it's the same fund. One is accumulation, the other is an income fund. And then we get the iShares MSCI World Quality Dividend Fund, which we saw the fact sheet for earlier. And you can even get ones which are sterling hedged, which is the case for this Fidelity fund. Now let's look at some US funds. And as usual, I'm always a little bit jealous because if you look at the expense ratios, they're much lower than they are for the UK, certainly for these cheapest funds at the top of the list. So these two funds from Vanguard, the one that we saw earlier, VYM, but also the Dividend Appreciation ETF, VIG, and the one from Schwab, its US Dividend Equity ETF, all three of those have a ridiculously low fee of 0.06%. And if we look at the one from iShares, HDV, the iShares Core High Dividend ETF, the fee there is 0.08, and the income on that currently is 3.4%. So as usual, US investors get a wider range of choices and lower fees. But if you want to find these for yourself, just look on Vetify, which used to be called ETFDB, and you'll see they have a very large free database of ETFs, and you can look for income funds there. In conclusion then, high dividend funds, as we've seen, have had an incredible start to 2022, but I'm slightly concerned that that may not persist once valuations start to normalize and growth starts to compress relative to value funds. That valuation's come down a lot, it has a bit further to go, but I'm not sure this outperformance will persist beyond that compression for growth. But it's true that while we have these kind of crisis conditions, and particularly during the sell-off, high income is probably a quite good strategy to weather the storm. However, I probably wouldn't put high income funds into my core portfolio. That's because by design, I want to put funds in there which I never touch. And I think long term, high income usually underperforms because growth is usually favored in the US, and that's the dominant global equity market right now. So as you can see, I'm not a huge fan of income funds. They don't form part of my core portfolio because I don't think they'll outperform over the long term for the reasons that we've seen. But over the next few quarters, I wouldn't be surprised if they do continue to perform well. And that's because growth has come off this huge peak of exuberance, and the multiple compression is going to take a while to fade as the Fed tightens monetary policy. Now, don't forget our offer with our free weekly market roundup. You can learn more about that by clicking on the link beside me and in the description beneath me. And as always, thank you for listening.